recession fears as well. So safe haven buying continues. Thanks a lot for that, Manisha. But let's get back to tracking equities now. Zomato is a stock on our radar, doing pretty well this morning. Mangalam is right here to tell us who's ordering what. Mangalam.
Well, a lot of people are ordering a lot of things, but the company is not spending as much, and which is why, operational metrics this time around have improved, and importantly, the disclosure of the company have improved as well. Adjusted EBITDA loss, the company believes, will break even in the next 2 to 4 quarters, and they've reiterated that, and they've said that they've strategically chosen to trade low-quality growth for better unit economics. So that's a marked shift from, the company's earlier chasing growth at the cost of profitability as well. Adjusted revenue for the company grew by 16.5% quarter-on-quarter. If you account, take Blinkit off, it's just a 9% growth. And adjusted loss also has narrowed from 190 crores. If you take Blinkit off, it's just about 60 odd crores. Importantly, the food delivery business has broken even on the EBITDA front. So, last quarter it was about 113 odd crore in terms of loss, and now it's become 2 crores. And the reason why the company's disclosures have improved is because earlier they had some unallocated costs, and that improved their operating performance of the segments. Now they've begun allocating that to various business heads, and most of them have come into the food delivery business itself. And despite that, the company has actually seen a break even in the food business. Why is that? Because the contribution margin of the food business has come in at 4.5%. The management believes that this is sustainable. What's working for them? Now that a lot of people know about Zomato and, operational metrics are doing well for them, they've seen lower ad spends as a percentage of adjusted revenue. From last year to this, now their ad spends are low by 900 basis points. So that explains improvement. And quarter on quarter as well, delivery spends as a percentage of adjusted revenue is normalizing to around 28%. The company has almost 12,000 crore of cash on their books, and they say that they're confident that shareholders will stop attaching zero value to Blinkit. So going forward, maybe that Blinkit play will come by too.
Something there, right? Bangalam, thanks very much for that. Now, Muthoot Finance is the other one. It's lower for the third quarter in a row. Numbers have been a miss. Abhishek is here with more. Abhishek.
Well, as I mentioned in Fin Street, earlier that NBFCs are losing customers to banks in terms of the gold financing. This continued for Muthoot Finance for now 2-3 quarters in a row. So they are losing customers to banks. AUM growth is one of the lowest that you are seeing in last 20 quarters on a YOY basis, coming in at just 3.8%. The gold AUM growth is just 3.3% YOY and about 0.6% sequentially. However, the gold customer base has declined by 3.84%, which means that the average ticket size is actually aiding the AUM growth over there. So net interest margin has improved by about 30 basis points sequentially, largely due to the fact that they have been able to control their cost of funds. So subsidiary performance is also weak. A housing finance subsidiary is under pressure on growth front, especially so in 7 quarters in a row. They continue to lose customers as well, both YOY and quarter on quarter, which is impacting their AUM, which has declined both YOY and quarter on quarter. The MFI subsidiary, that is Belstar, that has seen gross NPA rise for 3 quarters in a row, now at 8.5% versus 7.3% in the previous quarter. So in terms of PNL, both the NI and PAT is a miss, and CLSA has written on Muthoot Finance the underperformance rating continues with a target price of 1200 per share. They have cut the EPS estimate for FY23 to 25 anywhere between 7% to 8%. Back to you.
Okay, thanks a lot for that. That's Muthoot Finance. GNFC also on our radar this morning. Sonal is here to tell us why. Sonal.
Well, GNFC is declining on the back of very weak set of numbers. Overall revenues were down 4% for the company. EBITDA declined 28% to come in at 310 crore rupees. Margins at 12% versus 21% on a YOY basis, leading to a profit decline of 16% to come in at 237 crore rupees. Now, company has 2 segments, fertilizers and chemicals. So their fertilizer segment did really well this time, and the company says it was aided by better sales volumes on a YOY basis. However, the chemical segment, that is the one which did not do well and led to this margin decline. That is where they saw subdued realizations this time around. Sales volumes were also impacted because of an operational outage at their Bharuch complex in July 2022. So overall, weaker realization and volumes is what impacted company's performance this time around.
Okay, thanks a lot for that. So we're also watching out for Eicher Motors. Now, if you're wondering why the stock is down, despite a good set of numbers, the numbers were good. There were no problems over there. But on a quarter-on-quarter basis, the margins are lower. That's because of a higher mix of the low-margin Hunter product. So they sold more number of Hunter bikes, and the margins fell 112 basis points on a quarter-on-quarter basis. Now, we need to monitor if the scale increase and cooling raw material prices could offset the margin dilution because of the higher Hunter sales. So, if the Hunter sales continue to increase, which is of course a good thing, it may compromise on their margins, and some brokerages believe that it's fine. It's good that they are, they are perhaps looking to grow on volumes and maybe sacrificing margins for a bit, but the stock is under pressure because of that. Morgan Stanley says the upside to FY24 consensus EBITDA per unit and margin is limited, and the valuations also look full at the moment. So these are some reasons why Eicher is under pressure.
All right, 3571, 3.5% lower. We'll take a very quick break here. The market's cruising along nicely, 280 points. On the other side, we'll have Puneet Chatwal of Indian Hotels joining in to discuss their second quarter earnings performance. Stay tuned for that conversation.